Okay, so to provide some context to today's forum, we thought it would be helpful to provide you all a little bit of a summary of the work we did with FEMA through the flood insurance risk study. So I'm going to start my comments with a little bit of oversight on that. But then I'm going to turn to Florida and show some insights on how the NFIP portfolio in Florida shakes out, and hopefully provide you all a little bit of interesting color. In the process, I'm hoping my comments will bring out sort of two main themes. One, if you go about looking at flood risk management from the perspective of just simply actual loss history, it's probably not the best means in terms of telling the complete story in terms of trying to manage that peril going forward. But that being said, with technology and certainly a lot of what will be talked about later this morning, technology, underwriting tools, and the like, certainly enable, we think, the peril to be underwritten and managed. We see in the FEMA portfolio today opportunities for all of you to take advantage of that now. And we also believe as they continue their efforts to get their financial house in order, that's likely only to continue down the road. So, the flood insurance risk study, just for the sake of clarity, I think everyone's aware, that grew out directly from the aftermath of Hurricane Katrina and the reauthorization effort of the flood program back in 2012. In short, right, Hurricane Katrina, the way we look at it, it's to the NFIP, in essence, what Hurricane Andrew was to the insurance sector a bunch of years ago, really producing sort of a massive, ugly wake-up call that things have to change in order to manage things a little bit better from a risk management standpoint. The project basically contained three main components. There was a reinsurance study. Basically, we were asked to come in and lay out the groundwork for FEMA in terms of how reinsurance could supplement their risk management strategy. There was a privatization study, and around that, we were asked to lay out the framework. How might FEMA go about either partially or fully privatizing the NFIP? And where should various roles fall, whether it has to do with mapping and handling the insurance, claims management, and the like. And around that, what were the implications to stakeholders? The third component, really the most important component through which we could drive conclusions to the two main studies, was the underlying analytics to support all of that. So, when Guy Carpenter looked at that RFP when it came out, we were struck by two things immediately. One, the simple scale and scope of the ask was huge. And complicating that, we had a very, very tight timeline with which to respond to FEMA to cover all the issues. So at that point, we reached out. We built a consortium of companies to come to the table to not only help us supplement the resource around the work, but also make sure we were covering the landscape of the issues as best we could. Most of my comments today and a lot of the work that I'll touch on today, there were three main companies involved in delivering that. There was Guy Carpenter, ourselves. Our sister company, Oliver Wyman, played a big role in the privatization aspect. And then AIR Worldwide was there at the table helping us think through both claim-related analysis as well as flood modeling. They weren't the only companies involved. We also had our sister company, Marsh, involved, and a company, JBA Consulting, who provided very important support and some very important contributions to the work that was delivered to FEMA and is now with Congress. I can't emphasize enough, there was an absolute ton of work that went into building the analytics that supported FERS. Outside of about 700 pages of official written material that we gave to FEMA, and by the way, those reports, as I just mentioned, they are in the public domain. We had weekly discussions with FEMA. There was over 24 in-depth presentations we gave to them on modeling issues alone, so basically averaging once every 2 weeks. It was covering everything from claims and loss analyses through modeling to portfolio augmentation and how you get a portfolio just simply set to run through a model, all the way to more in-depth financial analysis and multi-year projections. The team, we spent 4 months alone just simply working with their data, going through modeling-related issues before any actual physical flood modeling was even being run. So, on this slide, we're basically laying out a component view of some of the loss metrics that were developed for the FERS study. What you see here is the 3 main components of loss and how they contribute to the average annual expected result under the portfolio. Inland-related flood modeling across the entire U.S. represents the largest component of loss. We're projecting that to contribute about $1.8 billion of annual expected loss, or about 39% of the total. Storm surge-related flooding was estimated at about $1.5 billion, comprising 33% of the total. And then the final component of loss, which we developed through actuarial methodologies, comes from non-modeled perils that are not currently captured in the models that are available. This amounts to about $1.3 billion of loss, or 28% of the total. The largest segment, as you can see, of this component comes from hurricane-induced precipitation, and that comprises roughly 18% of the total. So, the main takeaway from this slide, certainly surge losses, that's what's been driving or resulting in the deficits to the NFIP, but certainly as you look across the U.S., inland loss and the potential for inland flood losses represents a significant peril. The next 2 slides address the reinsurance and the privatization reports. I'm going to cover these really quickly because, again, if you haven't seen it, the reports are available in the public, and we can get you a copy if you'd like. The themes in the reinsurance study that we provided FEMA, we came at it from both an historic and a current market context. Around that, we outlined a high-level reinsurance structure for them and what that might look like. We actually put in front of them a few different options, and then we built initial cost-benefit analysis around those results. Major themes from the study, basically we covered practical issues. Practical issues being very simple ones. You know, FEMA's never been in the reinsurance marketplace before, so everything from who are the players, how does the process work, what are the implications of cycles and the market cycles which we're dealing with every day. From there to the more strategic, how FEMA might build a reinsurance cover and how do they build that over time as they're trying to grapple with a whole host of financial challenges. How do they access the different sources of risk capital that are now coming online, and how should they build that over time? And again, what are the financial implications to the portfolio as they do that? On the privatization study, we also provided a wide range of insight on a variety of issues. First and foremost, we took a look around the globe. Guy Carpenter itself has done a lot of work elsewhere around the world on the issue of flood. And for anyone who has taken a little bit of a look at that, you're going to find very diverse approaches to handling the issue. We conducted a fair amount of outreach to stakeholders. Again, purpose trying to bring as much perspective and different points of view to the table as we could in order to outline the different issues that FEMA needs to think through as they start coming up with solutions. But all of these efforts, basically, they culminated in about 5 broad approaches that we outlined to FEMA and how they could introduce varying levels of privatization. Everything from really covering the scope, full privatization to partial privatization. Some of the key themes that we uncovered and talked to here, right? The program's been in place for almost 50 years. And when we look at it and you start peeling it back, There are definitely issues within that we think can be privatized right away, but there are thornier issues that are going to take time. And how do you set up an appropriate glide path so you're putting all stakeholders on notice that they got to begin thinking about how they adjust? A framework and developing an appropriate framework to bring in the private sector. How do you do that and then make sure you're doing it in a fashion that's sort of sustainable over time? So obviously there are important issues to things germane to folks here in the room. Rating, form freedom. People have mentioned the issues of data and analytics and people's ability to understand the risk from their own perspective. We stressed the need for setting sort of a clear vision. And again, how do you bring stakeholders to the table and get them to play an efficient role for what they are in business to do? And really, again, the final thing that we tried to stress to FEMA is, ultimately, as they move down this path, there's probably going to be a matrix of solutions that are required, and then flexibility around those so that they can adjust as they move down the path. So where are we today? The first report was delivered to FEMA in September 2014 per terms of the contract. At that point, the work goes through a series of what they call a concurrence process, so a series of agency reviews before it actually gets delivered to Congress. That process took about 6 months, a little longer, and the reports finally were delivered to Congress last August. In the meantime, we have since been engaged by FEMA again to conduct some additional work, supplemental work around the first project. We are currently in the market now talking with over a dozen capital providers, sorting through what an entry-level reinsurance program might look and what the specific cost for that would be. Around that, we're going to be studying various alternatives, FEMA is going to be using that to make sure they sort the landscape that they need to on their end so that when they finally enter the market, they've got a process that will move smoothly. In concert with this, we are also doing additional financial analysis work for them. And again, this is going to help FEMA better inform lawmakers as the next reauthorization comes up in September 2017. Around the next reauthorization, we've already been hearing from folks as coalitions begin to get formed. People are thinking through the issues and getting their head around that landscape. Just today is just a quick call out. Our sister company, Marsh, together with Torrent Technologies, they're going to be releasing a paper on the topic and covering some of the issues. It's a blissfully short 13 pages versus the 700 plus that are built into our reports to Congress. But certainly some of the findings that you will see in there were colored by a lot of the work that we've done within FERS. So with that, let me turn and spend a few minutes talking to Florida and providing a little bit more insights on the state here. Okay, so on this slide, we illustrate the spread of exposure as measured by policy count across the country. Darker shaded states represent higher policy market share. So in 2012, our analysis studied over 4.4 million policies, of which at the time 1.4 million, or about 31%, were located here in Florida. The top 3 states, Florida, Texas, and Louisiana, they comprise almost 2.6 million policies within the FEMA portfolio and represent over 55% of the total. Around this, California and New Jersey, they round out the top 5. Combined, these 2 states have less than a 10% market share, so as you can see, smaller than Louisiana. Of potential interest around this, on 2015 data, if you've taken a look at that, That is currently showing, from our view, about a 5% reduction in policy count across the NFIP. 40 of the 49 jurisdictions you see represented on the map are showing reductions in policy count. So again, from our perspective, I don't know it for a fact, but it suggests to me that bank regulators continue to sort of ignore the enforcement of issues around the mandatory purchase provisions. Interestingly, the 9 jurisdictions or 9 states that are showing growth, they all have one thing in common, and that's the fact that they've all been experiencing flood losses recently. And that's another common theme you see within the NFIP over the years. Typically, it takes a large event to all of a sudden spur people to wake up and start purchasing the protection. On this slide, we now focus in on Florida. The map illustrates the spread of NFIP premium in Florida by county, and then the figures you see for the highlighted boxes are market share, again, by policy count. 56% of the NFIP policies are located in the 4 areas you see on the map. Jacksonville has the smallest share with about 5. Fort Myers area, 9. Where we are today, Tampa-St. Pete is about 12%. And then finally, the largest, Miami, has fully 30% of the NFIP policies in Florida. If one were to include Palm Beach County in the total, the entire group would represent over 62% of the business in the state. So as you can see on this chart and the prior chart, the NFIP, while it has spread across the country, and there are NFIP policies in every state, it's also got some concentrations across the portfolio as well. Another area where you see such concentrations in the NFIP are what come from their designated metropolitan statistical areas, or MSAs, and there's 7 of these across the country. 2 are located here in Florida. That's the Miami area and Tampa-St. Pete. Houston, New Orleans, and the New York area round out the top 5. And then Chicago and Sacramento fill out the 7. Chicago and Sacramento fall off dramatically versus the other 5. But when we went through the analysis in 2012, and this is all off of 2012 data that we worked with, FEMA at the time was putting out limits of about $1.3 trillion. 670 billion of that is located in these 7 areas. On this slide, we look at loss history. And to get a handle on this, our team, we studied over 2 million claim records, analyzing NFIP data from 1978 through 2012. A lot of work was done looking at all of the major events, as well as what we defined with FEMA as significant events, those being events where more than 1,500 claims were submitted. These events were then indexed to reflect exposure growth and currency valuation. So what this slide is telling you is, on the basis of actual history, Florida loss experience doesn't look that bad, and that's been reported on the press down here. I've seen that. Of $48 billion in total losses, Florida over the years has seen only about $3.6 billion, or 7.5% of the total. However, once you trend these losses, you begin to see a different picture emerge. On a trended basis, Florida losses grow to $19.4 billion, or almost 14% of the trended total. So again, where you see the trended total growing by a factor of 2, the Florida losses, given demographic shifts and exposure growth, has been growing by a factor of 4. On this picture, I come back to some of the average annual loss figures I shared with you before. But again, in the next 2 slides, I'm going to touch on some of the modeling results that we've seen. And again, it begins to tell a more evolved story. On this slide, on the left, you see the average annual losses we shared with you earlier, right? So basically showing a fairly even split between the 3 main components of loss, being hurricane-induced surge, inland flooding, and the non-modeled perils. But when one looks at Florida to the right, you see a different result. In Florida, the largest component of loss clearly comes from hurricane-induced surge. That represents 75% of the total, or estimated to be about $960 million average annual loss per year. The non-modeled component contributes about $230 million to the total. This is less than 20% of the total. Hurricane precip and tropical storm-related losses, they comprise the largest component at 13%. And then finally, inland flood amounts to only about $100 million, less than 10%. So the key takeaway here, hurricane-induced precip is obviously far less significant component of loss here in Florida. That being stated, when you look at the loss history, clearly hurricanes making landfall here in Florida have produced significant hurricane precip losses in other states. On this slide, I'll take you through a series of views. Here we're going to be focusing on the largest driver of the average annual loss in Florida, which is the hurricane-induced surge figures. I'm going to be showing blended results, so this takes the results we generated through each of the models, equal blending, and it does not incorporate any load for hurricane-induced precipitation. So this first line represents the modeled exceedance probability curve across the entire NFIP portfolio, right? The EP curve, basically what that does, it's providing probability of loss across various return period thresholds. And here what we're doing is calling out the 1 in 100 and the 250-year loss thresholds, being 15 and 21 billion respectively. This next line shows Florida, only storm surge. At the 1 in 100-year threshold, we see modeled loss figures coming out of 14 billion and just shy of 20 billion in total. Again, on an AAL, average annual loss perspective, the figures I showed you earlier showed Florida comprising about 50% of the total. The shape of this curve next to the U.S. total, again, not surprising, it shows that Florida is a key driver to that particular peril across the NFIP portfolio. The final line I'm showing is for some historical perspective. So here we show the trended loss result for Hurricane Ivan. Hurricane Ivan happens to be the last large loss that's impacted the NFIP portfolio here in Florida. It happened in 2004. At the time, it generated losses to the Florida portfolio of about $1 billion. Today, when you trend those, we think the figure would likely be closer to $2 billion. What we're showing here is the total U.S. trended loss for Hurricane Ivan of 3.2. Basically, that cuts across the return period threshold for the entire U.S. surge result at roughly the 10-year return period. So, on one level, clearly the modeling suggests that the loss potential for flood-related portfolios can be a lot larger than what history might suggest. Yet at the same token, if you look at the figures in totality at the 1 in 100-year level and the 1 in 250-year level, we would argue that there is plenty of room and there should be plenty of appetite for our industry to play a much bigger role in managing this portfolio. So, to finish, I thought I would just share with you all some quick comments on where we see premiums and the impact of assessments and surcharges and what's happening with that in Florida. It was mentioned earlier, right, with the passage of the Homeowner Insurance Affordability Act in 2014, there were certain rate adjustments that were built into Biggert Waters which were reversed or pulled back. I think that's all part and parcel of setting things onto a more appropriate glide path. As they made those changes, then they brought in surcharge components. The assessment pieces were already there. But we give you the details of what will happen with assessments and surcharges on the left. Basically, those have already started being baked into policies, and by April, I guess, yeah, end of first quarter next year, those will have been rolled out completely. To the right, we give you some quick comments as what's going on with rates across the two major classes of policies, the unsubsidized policies, which comprise the vast majority of policies here in Florida. 89% of the policies are unsubsidized. Those are going to be seeing rate increases that are basically tied to loss inflation. And then below that, the subsidized policies. And obviously, those are set to increase faster, depending on class of business. Those are going to be raising anywhere from 6 to the maximum 25% until they hit actuarial levels. The key punchline to this is, again, as I started my comments, we think there are opportunities within the current NFIP portfolio for insurers and reinsurers to take advantage of some of that business now and do so profitably. But clearly, as these steps move forward, those opportunities are going to grow. So I think I turn it back over to Tim. I hope you found some of that color of interest.